it? That warns. That is a dangerous exchange for physical divergence.
They now have to keep printing or retrench.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault, and to the entire Live from the Vault team worldwide. Happy New Year to you, and thank you for making 2021 our best year ever. And we're wishing you all the success and happiness and especially health in 2022. And we're certain that this is going to be another historical and record-breaking year ahead. As you can imagine, the Live from the Vault community keeps growing every single week, and we really, really thank you for your continued support. And with that, there's a lot to talk about during our first episode. Happy New Year of 2022. And during these historic times, we've got the one and only Andrew Maguire. He's in the house and will be, of course, talking gold. And we have yet another awesome episode for you today. So fasten your seatbelts. But just before we get started with Talking Gold with Andrew Maguire, please keep spreading the word about this channel by liking, by sharing, and smash that subscribe button. And then click on the bell if you'd like to be notified as these episodes go live. You're not going to want to miss any of it. So with that, it's my pleasure to head over to the UK with Talking Gold with the one and only Andrew Maguire. Hey, Andrew, first things first, Happy New Year to you and your family.
Hey, Happy New Year to you too, and Happy New Year to everybody, all our subscribers. It's been a great year, as you say. Hey, I noticed a nice, slick new opening here. Is this, I've just seen that for the first time. That's, hey, excellent work. We've got a great team here.
The new and improved. You can tell, Andy, 2022 is going to be a massive year for everyone, and we welcome everyone. So, Andrew, let's, as we usually start with a review, there's a lot that's gone on over the last little while, and let's maybe give everyone an update of what's happened since our last episode in 2021.
I know, and it seems like a million years ago. I mean, this is a fast-moving marketplace, but of course, we've got a lot of stuff to cover, and we'll cover it as quick as possible. But yeah, Shane, a good place to start is always with the summary of the action that we've observed, and I think we need to look at the action we'll look at first at this action in the first shortened session of New Year, which was last week, amazingly or not, and that commenced. It's important to notice that because there were a lot of people upset about the action. Hey, London was closed on that day, on the 3rd, and then of course we'll look at the action through non-farm payrolls. And then we're entering the first full week of 2022 trading, and with a focus, of course, as yet, on the unrealized Basel III NSFRs, which are slowly removing paper market hedging liquidity for COMEX shorts. Now, we're going to look at that in a minute. But let's start by summing up, because this is, I know, so many questions. People want to look at the action. They want to connect the dots. Why has it made sense? What has been the progress? So if we start by summing up this very rangy action, and if you look at it, it's actually not that volatile. But people sort of get upset whenever we see any kind of selling. But we'll look through that. We're looking at the first 8 trading days. We're recording this on Wednesday. This is the 8th trading day, and we'll look at why really we should expect. And why we should expect higher gold and silver prices into the first quarter. So the COMEX-centric bearish session that commenced on the 3rd of January, which was the Monday, impacted a gold and silver market which really lacked both LBMA gold and silver fixes, which the physical market, of course, requires to benchmark wholesale gold and silver prices to. So this was a 100% COMEX-centric action. But what it did was provide us a perfect example of where the gold and silver market selling emanates from. And it really highlights this is how synthetic in nature this action is. Of course, that was that little window when the market, when the fixes weren't there and the wholesale market was essentially closed. Now, COMEX speculators are really blinkered to any view of the underpinning physical market strength. And they were led by the nose in that session by the market making insiders pulling bids into an illiquid, really a liquid market at this point. And so what they did was begin exercising old muscle memory, into inversely correlated rising bond yield inputs. Now, if we talked about this before, how these base algos, it's a 95, 98% algo driven market. So if we see a rising bond yield, we see an inversely correlated spec program that sells silver, sells gold into a rising bond yield. So, so this old muscle memory, they've got no view into the physical market underpinning this. And of course, what that did was immediately we see what they did was essentially sell gold from the top of this range. We're talking about this rangy sort of area between 1800 and 1830. So they sold it from the top of the 1830 range, and that's an options range that we talked about in our previous episode, right to the bottom of that range. But with insiders exposed to the physical market, and we'll talk about that in a minute, they were one-to-one long against these speculators. And the deliberately delayed COT report, which of course a lot of people study this COT report, it shows who was what category of trader was long or short, etc. It really captured a fraction of this action where the commercials were going long against the speculators. And so the spec-driven bearish price action was followed the next day on the 4th, which is when we joined the market. It was the first full liquid session of the year. It's good to connect these dots because, it's easy to say one thing and then not understand where we came from to understand where we're going. So what happened? That was the first time we had a strong physical buying, came in benchmarking the first gold and silver fixes of 2022. Pretty close to where they closed, but higher than where they closed in 2021. Now, the physical market, along with the market-making COMEX commercials, these are the market-making commercials on the COMEX, they jumped on, and the physical market jumped on the paper-induced discount, driving gold futures right back to the top of the 1830 range the very next day. 100%, that was, but here's the important point, 100% driven by very strong physical buying. Now, it was quite evident from discussion with our liquidity providers as we started trading on the 4th of January, because obviously we want to find out where are the liquidity, where is the paper price versus the physical price. So that gives us an idea of what to expect and who's going to be buying or selling where. And so what we found was that the COMEX-centric commercials were definitely reluctant to add any shorts that they couldn't back up with a legitimate, fully backed, over-the-counter position that will ultimately lead to stronger prices. And again, we'll drill down into that in a little while. But this beggars the question, where was the selling coming from then? So specs trading, a 100% cash-settled futures market, are really conditioned to thinking that chasing a dot on a screen from infinite to zero in a cash-settled non-delivery market is a viable trading option. I mean, that's unbelievable. But this is a strategy which is clearly in play. And this is because they don't have any visibility into the physical supply-demand fundamentals underpinning the gold and silver market, nor is it on their radar that Basel III regulations will significantly reduce the paper-driven tailwinds that they are psychologically, psyoped into believing and thinking. Now, the resulting self-fulfilling chart-baited historical trend lines, the moving averages, the paper-centric pivot points, have historically led these speculators into becoming patsies to periodic, insider-driven, led by the nose, self-ignited, sell the rally market waterfalls. Now, these are easy to generate if you've borrowed money off the house. And this is where the banks bankrolling specs who've borrowed these leveraged positions off them rig these paper traders into a position where they can call these loans in at a profit, simply. We've been through this multiple times. It is not rocket science, but without the blinkered COMEX-centric speculators into this mix, the 50 years of price fixing ranges really could not have been managed. But for those of us that monitor the paper to physical balance, and our subscribers, this is what we focus on, the balance, we're trying to balance there's a structural change that is becoming evident between the physical and the paper market. Yes, gold is fundamentally undervalued below 2,000. Oh yeah, why is it not at 2,000? Well, there's reasons for that. But it takes a little time for specs driving this paper gold and silver selling to realize there really is no need to sell the rally into an increasingly physically driven marketplace. So from here on, we will start to evidence a spot market that will increasingly be physically deliverable, but being blind to fundamentals, it will take the resulting option structures, the moving averages, the trend lines to begin to morph into a physically driven market to force a change in spec trading behavior, i.e. they will be wrong at both ends.
Now, Andrew, definitely we want to get into Basel III. Got a lot of questions on that. But just before we do, what do you think this means for the actual price of gold now?
Yeah, Shane, great question. I mean, if anything, as the process unfolds, we're also going to see paper-driven upside price overshoots of steadily rising physical market support. So I can see this going the other way too. Of course, we're used to the downside spec overshoots, which have been the lever for decades of official gold price management. And of course, that's greatly enriched the insiders, the agent insiders. Now, this process is irrevocably underway, but it's like a tanker changing course. It takes a little time to turn. Now, drilling down into the new year action, the paper-driven automated spec selling has continued to key off these inversely correlated strong bearish bond, rising bond yields, strong dollar crosswinds. Hey, really a strong dollar should not be a weak gold. A strong dollar is often a safe haven move. Safe haven, well, I mean, obviously it's as far as every currency goes, it is a safe haven versus other currencies. But also we sometimes see gold and the dollar rising together. It's been more about the bond yields. Rising bond yields have triggered these sellings, this spec selling. Now, that completely irrelevant to the fact that long term that real interest rates are negative. But following this action, and again, we'll just connect these dots and we'll get to where we're going now. So following this hawkish Fed, if you remember the hawkish Fed last Wednesday, that perfectly set up the obligatory non-farm payrolls gaming last Friday. We always talk about this. It's always a heavy event. Specs were severely wrong-footed because of these two events. The hawkish Fed tanked the market, the gold market, tanked the stock market. But of course, we knew the Fed would step in there and rescue, stick save that. But again, it left the specs really wrong-footed. But this week, the automated spec-driven selling ran into strong physical buying, and we reported this. But we were reported to this by our January the 4th morning liquidity provider meetings. The physical buying forced commercials, let's face it, unwilling to take fresh short positions. It forced them to stand aside, and they're now reduced. And this is the change in behavior. They're reduced to bid pulling tactics, not adding shorts, with a physically driven undercurrent ultimately overcoming these spec sellers, because it's purely spec selling with the commercials pulling a few bids. Now, commercials they're undoubtedly taking the long side of every blind spec sell order. So really, old muscle memory into rising bond yields and a stronger dollar has evidenced spec sellers appear at every single pit open. You've noticed that. However, this divergent paper to physical action drove the February the February futures contract deep into backwardation. We talked about backwardation, where you've got a further out futures market trading at a discount to the cash market. That warns. That is a dangerous exchange for physical divergence, highlighting that the underlying bullish physical drivers, which is competing against the COMEX sellers, emanates from a strong bottom-up physical demand. So it's the physical market that's beginning to drive this.
Now, Andrew, I remember you were probably one of the first to start talking about Basel III and the standards. Can you tell us what's happening now that Basel III is now evidently fully into effect starting 2022?
Perfect, Shane. This is the elephant in the room, and I see so many people not getting this. It is not an obvious thing. We're talking about a residual spec momentum, old muscle memory carrying through to to players that don't get there's a physical side. So the action we've seen has barely lifted the covers of this very real bullish effect. And what's becoming clear, though, is that liquidity providers, this is the all-important, this is where the 10 times larger market, the over-the-counter market, has liquidity providers and so it's these liquidity providers that are becoming, when you see these backwardations and you get the threat of an EFP blow-up, they're reluctant to provide over-the-counter spot FX market liquidity on positions they cannot back up with physical if called upon for delivery. Now, this is the big change. Over-the-counter market used to be 100% paper, almost 100% paper. So this change seriously eats into the virtually limitless volumes of long, unbacked, over-the-counter paper positions that liquidity providers were historically able to hedge with offsetting COMEX shorts. And so this was, if you remember, paper hedging paper. But that enabled massive position concentration to rig the prices at will. But following the implementation of Basel III NSFRs, market-making commercials in this 10 times larger spot market do not want to put themselves in a position they cannot quickly exit. And therefore, gold and silver naked short buying and selling is now almost exclusively in the hands of the COMEX-centric specs. This is important to understand. And these guys have, as I say, no visibility into the much more relevant, strong physical market. This is creating an opportunity for us. And given this unseen change in market structure, it would be a huge mistake to discount that a March 2020 style EFP blow-up could not be repeated. If you remember, that was a $600 move higher. Now, drilling down a little, and again, getting to it because we're connecting these dots, it's so important to understand why. Drilling down a little, since the open of liquid trading, when London commenced trading on the 4th of January, gold futures have become permanently and severely backwardated into this spec-induced selling. That has our attention. It has the attention of every liquidity provider. It has the attention of every first and second tier market-making bank. And it doesn't have the attention of the specs. So in trying to continue to contain gold futures below the 1830 window, and if you remember, we talked about this, this was the last levels that we said, the BIS doesn't need gold below 1805, and it really likes to cap it at 1830. This has been the range. And so they've been trying to keep this cap, though, at 1830. But this puts commercials in a difficult position. And if the commercials don't one-to-one continue to take the long side of every single algo-driven spec sell order into tightening physical supply, it will also spook the remaining 8 to 12. A lot of these are minor liquidity providers. There's one or two bigger ones there. It'll spook the 8 to 12 remaining over-the-counter liquidity providers, risking the exchange for physical conduit to expand. Now, we've discussed this in detail in prior episodes, so I won't bore you with the detail of it, what an EFP is, but it is essentially the way you can take delivery of a COMEX contract into the spot market, which is deliverable, essentially. So now we saw that this week expand to a $2.20 spot market premium to futures. Now, hang on. This is supposed to be the most liquid market in the world. And so that should not be happening. And that forced liquidity providers to withdrawing the necessary over-the-counter market liquidity to avoid the risk of a March 2020-like EFP blow-up. So really, what we're saying is only a price rise can resolve this COMEX-driven selling, which has driven the February contract, which is about to expire at the end of this month, deep into backwardation, spooking these liquidity providers, widening the spreads, which illustrates the widening divergence between spot and futures markets. That's going missed by these COMEX-centric traders. So in other words, liquidity providers will have to back over-the-counter positions with physical gold that may at any point be called for delivery into a tightening physical market. So any unbacked over-the-counter long positions head short on the COMEX could be called for delivery, once again sparking a bid-only COMEX short squeeze. That was when, if you remember, March 2020, we saw that happen. Liquidity providers freaked out because everyone knew, and I'll tell you why this is relevant in a minute, because of the supply constraints. Because of the supply constraints back then, what happened was the over-the-counter providers were wheeled on to demand delivery. Well, they didn't have the physical. So it's suddenly, to cover these positions, there was a $100 spread per ounce spread between hundreds and hundreds of tons of positions that they were called for delivery on. $100 an ounce. We went bid only on the COMEX as these guys have tried to cover their shorts to really exit a position they could not deliver on. So this is important to remember, because this is the Achilles heel. Now, really, this experience forced a lot of second-tier banks who face millions in unrecoverable intraday losses to exit, and they have not returned. So this is an even more dicey situation. It's not as liquid as it was back then. So while gold futures are trading back inside the 1805, 1830 BIS determined range that we discussed back in the last episode, silver has some catching up to do, and it will take a breakthrough of stops above the 10-day moving average, which today seems to have happened, but really its option sweet spot are way above 23, and there is a magnetic pull further out into its $26.25 inflection point. So we see that, and there's reasons for that, and I see your ears perk up, Shane, when we mentioned silver. But perhaps we could just keep this thread going, and then we'll look at the silver. I know we talked about this earlier, and I know you're excited about silver, but look, again, just to finish this kind of trail. So while we expected these Spec 7 driven dips into non-farm payrolls, we were also aware that the BIS gold sweet spot has not yet risen from what we assessed in our last episode. It is still between 1805 and 1830, with the further out option structure signaling resistance is lightening up. And that's not to say that 2000 isn't coming, but soon, but not right now. So it's still going to require this tanker to do a little bit of a turn. It's happening. Now, the hawkish Fed a week ago, last Wednesday, that threw a wrench in the short-term action because there were sufficient spec sellers to override the underlying strong, unleveraged physical demand. But the footprint's 100% evidence that specs have been doing all the selling. I cannot underscore that enough. With commercials largely restricted, as I say, to little bits of bid pulling at the moving averages. And that's really the action which has been the driving force into this first 8 days of 2022 trading. So to really answer your question, Shane, Basel III net stable funding ratios will increasingly disincentivize first and second tier banks from providing spot market liquidity they can't deliver upon. And it will take a few sessions to really filter through as the COMEX central muscle memory will continue to key off these historical but outdated sell the rally trend lines. But market making commercials will use these dips to buy, as we are. And although specs have not realized it yet, Basel III conditions will now rely on these specs holding the bag on all naked short sold positions, while conversely, the market making over-the-counter hedges beginning to morph into physically backed COMEX shorts. Now, these blinkered paper traders have no visibility into the physical market underpinning these trades, and this will only become visible to them after these bullish bottom-up forces influence the technicals they trade on, by which time commercials would have loaded the boat long sufficiently to benefit from higher gold and silver prices.
Yeah, Andrew, as we're talking earlier, we were chatting and you had mentioned something about the CME changing the way that performance bonds are being weighted for commercials. Can you maybe tell our viewers a little bit about what this means and what is it they're trying to address here?
Yeah, great. Yes, we were talking about this. CME activities. I think drew attention to this earlier this week. Now, so sum it up kind of, in a watered down first stage move to tighten up COMEX hedging compliance, which will ultimately jive with Basel III NSFRs in all commodities, the CME has introduced what is a two-tier performance bond requirement. Right now, there's little noticeable change, and in fact, don't see anyone talking about it, but we would watch this closely as physical begins to back up these over-the-counter hedges, which is really this is all about hedging. So this is interesting. It's no surprise, though, that the introduction of a two-tiered performance bond requirement favors the reporting market-making commercials in them when they instigate a fresh long or short COMEX position. Now, this is affected by the introduction of a CME, and it's called a heightened risk profile, HRP in short, which is a category which essentially raises the cost for specs to open up a fresh or new short, longer position, while the commercials can open up a fresh position with a far lower risk weighting. So HRB category trades are primarily spec open interest additions that are not designated as hedges, so higher risk profile. And these are now apply a higher CME risk weighting to instigate a fresh trade. So conversely, on the other side, non-high risk profile accounts, non-HRP accounts, are deemed to be hedge transactions, largely commercials and officials. So initial and maintenance margins will be weighted at the lower maintenance cost, while specs will require a higher initial margin to open a trade. So the CME announcement this week also came on the back of cuts and decreases in margin borrowing costs in both categories of gold and silver futures, but that's irrelevant really. And for those that haven't noticed, I'm sure a lot of traders have noticed that in gold futures, the HRPs, the commercials, initial margin reduced from 7,500 to 6,500, and the maintenance at 6,500, which is quite low actually, while specs initial margin reduced from 8,250 to 7,150 to initiate the same trade, after which the maintenance is 6,500, which is matched with the hedge positions. Sorry to go through this, but these are questions that we get. Now, but this is the important point, I think. Given COMEX gold and silver trading is in a plus 95% HFT-driven, algo-driven market, this concession clearly favors the commercials and officials who operate in a fast-trading algo environment. And the lower barrier to entry will undoubtedly assist them in employing such tactics as bid pulling, which we're seeing, versus risking adding shorts, which may be called upon for EFP delivery. However, the long over-the-counter positions backing up and hedging the COMEX shorts have to be NSFR compliant. So we will see this historical naked shorting COT tactic beginning to evaporate.
Now, Andrew, earlier on you did touch on silver and you did catch my attention, and maybe you can bring us up to date in terms of what you're seeing right now for our silver stackers out there.
Oh gosh, yeah, this is such an exciting time, and also an exciting time for anyone in my goodness me. I mean, silver, the most undervalued commodity on the planet Earth. I mean, what an opportunity. I cannot believe it. We're testing 23 today, and what a joke that is. But anyway, these same actors in silver futures are also going to benefit from the Basel III over-the-counter gold positions being increasingly backed by physical. In turn, it's going to force this extremely bloated ratio trade to unwind, which in turn will allow oversold silver to catch up to a rising physically driven gold price. You cannot keep expanding that ratio trade. It's become ludicrous already in the 80s. So while silver futures don't have to be, or silver doesn't have to be NSFR compliant, although really all commodities ultimately will be too. It's going to push the ratio. If it pushes the ratio trade too far out, it's going to backfire. So we would anticipate a residual bullish effect, but margin requirements to initiate the trades that we just saw with CME, it really also favors the commercials. And in this case, with immediate effect, both categories decrease. So in other words, so basically, whether you're an HRP or a commercial or you're a speculator, the margins have reduced. But again, it's favoring the commercials who basically can come into a market with 9,500 as an opening trade and a maintenance trade, whereas a speculator has to have 10,450 and then maintenance at 9,500. So essentially, that's where we are immediately with silver, the most undervalued commodity on the planet Earth.
Now, Andrew, last year, it seems weird to say last year, but it was just last year in 2021. You were really concerned with the tightness in the physical markets, and you said something about it might force another EFP blow up. Can you maybe update us on, or maybe share something interesting about the refinery supply issues that you were talking about?
Yeah, I'm going to share something that's not in the news. But first, Shane, let's see this. And I see this as extremely relevant because on the other side of this pricing equation, we're evidencing extremely strong physical demand, which has driven, again, February gold deep into backwardation to spot, which is once again risking this EFP event that we must come back to that. This is especially relevant as liquidity providers are exposed to this Basel III NSFRs. They're limiting the provision of spot gold liquidity on positions that may ultimately call on for physical delivery. Now, we've seen backwardations, as I say, as deep as $2.20, which is ludicrous. So bottom line, the heavy action we've been experiencing is almost exclusively spec driven, with commercials restricting their capping activities, as I say, to just bid pulling at the moving averages and letting the specs carry the load. Now, the buying pressure is evident in the physically driven spot gold market, while the paper market sellers are evidencing this backwardated Fed futures illiquid paper conditions. Now, goodness me, a couple of days ago, yesterday, and the day before, we were evidencing 2 and 3 tick spreads between the bid and the ask on what is the front month February contract. It just illustrates how HFTs reach inflection points where they suck out any legitimate paper market liquidity into a physically driven divergence. Now, this is where it gets really interesting, and I'm going to pull something up here, which is. It's just not being written about. It's not anywhere in the mainstream media. This week, European refiners started to cut production. This has not been reported by any mainstream media, and we're beginning to evidence tightness in supply, not realized by the specs selling into the rising bond yields. I know that the commercial market makers are aware of this information. I'll read it, this section to you in a second. And this explains, though, the divergence in the consistently backwardated February contract, futures contract, but it could get far worse for blinkered spec sellers. They're blind to this information. This condition will have liquidity providers, though, attention. And it's the first time since March 2020 that refiner capacity in Europe has bottlenecked. Now, I quote from a letter from Argo Horaeus, and it's right at the top. It says, COVID-19 pandemic, Omicron variant, the most contagious virus ever. Well, okay, we figure it's a bad cold, but in Europe, they seem to be, the markets really seem to be stretched. But there's a paragraph in here that this is the paragraph here, and it's basically our partners are of the highest importance to us. We would like to proactively inform you that unfortunately, due to the high number of absences, we have to plan a reduction in production capacity. The situation is constantly evolving and therefore also unpredictable. We're gearing up in order to be able to serve you in the best possible way. We will do our utmost to remediate and to keep you constantly informed in the situation. You'll be actively contacted by your contact person shortly to define and agree specific actions. Well, hold on a minute. They're saying here that we have an issue. We have a bottleneck. We don't have people turning up for work. There isn't enough people to refine the product. This is crazy. So what are we seeing? So this clearly illustrates that it can only be the speculators doing the selling here. So following this refinery warning, physical supply tightened to the point that the liquidity providers got really spooked in providing liquidity in the over-the-counter markets. And look, when you get backwardations into a front-run futures contract, which is further out at $2.20, which is actually starting to jive with the April contract, into automated spec-driven selling, keying off these inversely correlated rising bond yields and stronger dollar, with these 3 tick spreads between the February bid and the ask, hey, you've really got everyone's attention here. And really, they're starting to get really spooked by this situation. So really, to sum up this action and the potential risk if prices don't rise from here into such strong physical tight demand, it would be a mistake to discount that a March 2020-esque EFP blow-up will not be repeated. And let's not forget, the short covering that ensued drove a $640 rally, driven by the inability to deliver physical bullion. Look, yes, okay, back then there was nobody at work, but it was the fact there was no physical available. And suddenly everyone turned to the over-the-counter market and said, give it to me. And they couldn't. Now we have Basel III regulations that say you better have some physical to back up those positions. So now you're being a little more cautious about what you put out there, and you better make sure that it is covered. Hence, the commercials on the COMEX are also aware of this game and are not putting themselves in a position where they're going to get screwed on a bid-only short covering market. So now gold prices futures are permanently backwardated and severely backwardated into this spec-induced selling. Now, if a commercial doesn't one-to-one take the long side of every single algo-driven spec sell order into this tightening physical supply, it'll spook the second-tier liquidity providers to completely exit the provision of necessary over-the-counter liquidity to avoid the risk of a March 2020-like EFP blow-up. So February backwardations have already begun spooking these liquidity providers, illustrating the growing divergence between the spot and the futures market. So in other words, if liquidity providers will have to they have to back up these over-the-counter positions with physical gold that may at any point, and it could be, especially now you see refinery issues here, at any point, it could be called on for delivery into this tightening physical market because there's a hell of a lot of demand out there. And yes, we've seen retail premiums soaring. I mean, we saw those soar at the end of 2021. We saw Krugerrands in Europe fetching retail prices in wholesale markets. I mean, so that was the retail market. Now we see this start to really bite. And any unbacked long positions head short on the COMEX could also be called for delivery here, sparking a bid-only COMEX short squeeze. So the gold supply crunch came on the back of the Kazakhstan airport being closed last Friday, halting deliveries of around 600 tons of silver. Actually, we just got it out last Friday ahead of this airport being... but I think that kind of has got resolved. But it kind of illustrates just how fragile these supply conditions are, and how suddenly, if 600 tons of silver if they hadn't solved this problem immediately, 600 tons of silver would not, which has already been pre-purchased, would not have arrived. Now, okay, but these obviously we've seen some sort of regime change, and now we find out that all these producers will face much higher costs. Well, what's that going to do? That's going to raise the cost. So I think bottom line, all in all, we're looking at a structurally very bullish setup for 2022. Yes, officials can still operate in the unallocated over-the-counter markets. Yes, of course they can, but a very large volume of their supporting unallocated gold credit is drying up. Agent banks cannot afford to roll unallocated liabilities onto their balance sheet. These are too big to fail banks. You cannot hide this. and driving the price too low into a negative real rate environment, which we have, into what it's going to do is going to open gold up to competing central banks buying, draining safe haven physical supply. It's no surprise to see every first and second tier bank long physical of their own book, and a higher price this year will just suit them very well, and us too.
Wow. Well, thank you very much. That's Talking Gold with Andrew Maguire. And I'll tell you, I knew this episode was going to be a blockbuster. So remember, buy physical and understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They are not the same. Don't be fooled. And there you have it. That's all we have for you today. Another fascinating episode of Live from the Vault. Please help spread the word about this channel by liking and sharing and subscribing. And don't forget to click on that bell notification if you want to be notified as these episodes go live. With that, we will see you next time on Live from the Vault. See you then.